Ever considered improving your credit score in the year 2024? Allow me to explain the concept of credit scores. Consider a credit score as a financial passport. It's a 3-digit number that has the power to either open or close opportunities for you. It shows how reliable you are with finances, summarizing your economic health. So, why should this concern you? The answer is straightforward. The better your credit score, the more attractive you are to financial institutions like banks and credit card companies. They use your credit score to determine whether they should lend you money and at what interest rate. A robust credit score can make obtaining loans and credit cards easier and often under more favorable terms. Moreover, your credit score can sometimes influence your employment prospects. Certain employers, particularly in the finance sector, could check your credit score during the hiring process to assess your financial responsibility. Now, imagine your credit score a valuable asset like a financial treasure. Just like any investment, your credit score requires care to flourish. A high credit score can help you attain your financial goals, whether it's buying a house, launching a business, or achieving financial stability. It acts like a discreet safety net, providing you with more options and better conditions when needed. In the realm of finance is power, and this holds true for understanding your own credit score. It's more than just a number, it reflects your financial habits, reliability, and future opportunities. So, irrespective of you're a finance expert or just starting your credit journey, it's crucial to comprehend the significance of a good credit score and its potential to transform your life. Being aware of your credit score is the initial step towards improving it. Do you know what your current credit score is? It's a question many of us might overlook, but understanding this number is key to unlocking your financial potential. So how does one find out their current credit score? The first step is to visit an official and secure website. Major credit bureaus usually provide free annual credit reports, and there are several reputable online platforms that allow you to check your score at any time. Now, let's discuss the credit score range. It typically falls between 300 and 850. A score below 600 is considered poor. Between 600 to 700 is fair, 700 to 800 is good, and anything above 800 is exceptional. Your credit score is a reflection of your credit worthiness, and it's what lenders use to determine if they'll lend you money and at what interest rate. Knowing where you stand is crucial before you aim to improve. So take that first step. Find out your credit score today. And do you have any outstanding debts that are weighing down your credit score? If the answer is yes, you're not alone. Many find themselves in a similar situation, but did you know that these debts could be the invisible chains holding your credit score captive? Outstanding debts play a significant role in determining your credit score. They're like a shadow, following your credit score around, pulling it down. Every missed payment, every defaulted loan, every unsettled credit card bill, they all add up. And not in a way that you'd like. A high amount of debt compared to your overall credit limit can make you appear riskier to lenders, causing your credit score to decline. This ratio, known as your credit utilization rate, is a crucial factor in credit scoring models. The lower your credit utilization rate, the better your credit score tends to be. But there's good news. Clearing these outstanding debts can make a world of difference to your credit score. Think of it as lifting that heavy weight off your score's shoulders. The moment you start paying off your debts, your credit score breathes a sigh of relief. And so do you. Now, it's important to understand that clearing debts doesn't mean you need to pay everything off in one go. Not everyone has that capacity. Instead, it's about making steady, consistent payments towards your debts. It's a marathon, not a sprint. And remember, it's not just about paying off the debt, but also about how you manage it. Making timely payments, not taking on more debt than you can handle, and maintaining a low credit utilization ratio can all contribute to a healthier credit score. In the end, clearing your outstanding debts is not just about improving your credit score. It's about gaining financial freedom, about breaking free from the chains of debt. It's about taking back control of your financial life. So don't let outstanding debts hold your credit score hostage. Start clearing them today. Because clearing your outstanding debts is a guaranteed way to give your credit score a boost. Are you making your payments on time? Now, this might seem like a simple question, but it's one with profound implications when it comes to your credit score. You see, consistent, timely payments form the very bedrock of a robust credit score. Every time you pay your bills, loans, or credit card balances on time, you're sending a positive signal to credit bureaus. You're showing them that you're a responsible borrower, that you can be trusted to manage your financial obligations efficiently. But what happens when you miss a payment or make a late one? Well, it's not a pretty picture. Late or missed payments can put a significant dent in your credit score. They indicate to credit bureaus that you might be struggling to manage your finances, that you might be a risky borrower. And even a single late payment can stay on your credit report for 7 years. That's 7 years of potential lenders seeing that missed payment and possibly thinking twice about extending credit to you. But let's not dwell on the negatives. The good news is that the power to maintain a healthy credit score is in your hands. By making consistent, timely payments, you can steadily build up your credit score, showing the world that you are indeed a responsible borrower. And remember, every payment counts, every payment matters. Timely payments are the backbone of a healthy credit score. Are you using your credit responsibly? Let's delve into the fascinating world of credit utilization ratio. This term might sound a bit daunting, but it's rather simple. It's essentially the percentage of your available credit that you're using. Now, why is this important, you may ask? Well, your credit utilization ratio directly influences your credit score. Here's an interesting fact. Keeping your credit utilization ratio low can actually help improve your credit score. Sounds a bit counterintuitive, doesn't it? But it's true. Lenders prefer to see that you're not using all the credit available to you, as it indicates you're managing your finances well and are less likely to default on repayments. So how do you maintain a balance between using credit and paying it off? It's not about completely avoiding your credit. Instead, it's about using it wisely. Aim to keep your credit utilization ratio under 30%. This means if you have a credit limit of £1,000, try not to use more than £300 at any given time. To maintain this balance, it's crucial to keep track of your spending and make timely payments. Setting reminders or automating payments can be a great way to ensure you don't forget. Moreover, try to pay off your balance in full each month, rather than just making the minimum payment. Remember, it's not about having credit, it's about how you use it. Responsible credit usage is the key to a good credit score. When was the last time you checked your credit report? A simple question that many of us tend to overlook, yet it's one of the most vital steps in maintaining and improving your credit score. Just like how a regular health checkup can prevent unexpected illnesses, a routine credit report check can safeguard your financial health. It helps you spot errors, suspicious activity, and even signs of identity theft. It's your first line of defense against these potential hazards. So how often should you check your credit report? At the very least, aim for once a year. But if you're actively working on improving your credit score, you might want to check it more frequently. Every 4 months would be a good rule of thumb. Now, let's say you come across an error in your report. Perhaps a payment marked late when you know you paid on time, or a credit card you never opened. What do? First things first, don't panic. Errors are not uncommon, and there's a process to handle them. To dispute an error, you'll need to contact the credit bureau that produced the report. Write a letter detailing the error and provide any supporting evidence you have. It's a good idea to send this via certified mail so you have a record of your dispute. The bureau is required by law to investigate your claim within 30 days. If they find the error to be valid, they must correct it and notify all other credit bureaus. As for protecting against identity theft, regular credit report checks are your best bet. Unusual activity, such as unfamiliar accounts or sudden changes in your credit score, may be signs of identity theft. If you notice anything suspicious, report it immediately to the credit bureau and the authorities. Remember, your credit report is a reflection of your financial habits. It's what lenders, landlords, and even some employers look at when deciding whether to trust you. So stay informed. Keep a close eye on your report. A regular check on your credit report keeps you informed and in control.